In the realm of real estate investment, understanding the concept of depreciation and the implications of depreciation recapture can significantly impact an investor's financial strategy and tax situation. Depreciation recapture is a crucial concept, particularly for investors seeking to sell property. This article will explore the definition of depreciation recapture, how it is calculated, and strategies for avoiding or minimizing the impact of recapture taxes upon the sale of real estate. Depreciation recapture is a tax provision that allows the IRS to collect taxes on the financial gain resulting from the sale of a depreciated property. Essentially, when a property owner sells a property for more than its depreciated value, the IRS taxes the portion of the gain related to the depreciation deductions previously taken during the period the property was held by the owner. Real estate properties, except for the land itself, depreciate over time. The IRS allows property owner to deduct this depreciation from their taxable income, essentially recognizing the cost of wear and tear on the property. This deduction reduces the owner's taxable income, thereby lowering their tax liability during ownership. However, if the property sells for more than its depreciated value, the government seeks to recapture some of those benefits. Depreciation recapture is calculated on the portion of the sale price that represents recovery of the depreciation deductions previously claimed. For residential rental properties, the IRS generally allows depreciation deductions using the Modified Accelerated Cost Recovery System, or MACRS, which typically involves a straight-line depreciation over 27.5 years. When you sell the property, if the sales price exceeds the property's adjusted basis, which is its original cost minus depreciation deductions, that excess is subject to depreciation recapture. However, it's capped at a maximum rate of 25% for real property under Section 1250 of the tax code. Any profit beyond the depreciated value is taxed as capital gains, which might have a lower tax rate depending on the seller's income and the duration of property ownership. Let's look at an example. Imagine the original purchase price of a property was $300,000. Over the years, a total depreciation of $100,000 was claimed. This leaves us with an adjusted basis of $200,000, which is the original purchase price minus the total depreciation. Now suppose the property is sold for $350,000. The depreciation recapture amount would be the lesser of the gain on sale, which is $150,000, or the total depreciation taken, which is $100,000. So in this case, up to $100,000 would be subject to the depreciation recapture tax rate. While avoiding depreciation recapture entirely may be challenging, there are strategies to mitigate its impact. First, the 1031 exchange, also known as a like-kind exchange, allows you to defer paying depreciation recapture and capital gains taxes by using the sale proceeds to purchase another similar property. Specific rules and timelines must be followed carefully. Second, offsetting gains. If you have capital losses from other investments, you can use them to offset the capital gains from the sale of your property, potentially reducing the overall taxable income, including that subject to depreciation recapture. Third, investing in improvements. Reinvesting in your property to improve or enhance its value can increase the basis of your property. While this doesn't eliminate recapture, it can reduce the gain on which recapture is calculated. Fourth, consideration of selling strategy. Sometimes selling a property over time using the installment sale method can spread the tax liability across several years, potentially reducing the overall tax rate. And finally, charitable contributions. Donating real estate to a qualified charity can provide a tax deduction for the fair market value of the property, avoiding capital gains and recapture taxes. It's essential for property owners to plan their sale and tax strategies, with a comprehensive understanding of depreciation recapture. Consulting with a tax professional or financial advisor is highly recommended to navigate the complexities of real estate transactions and taxation efficiently.